Hello and welcome to this week's edition of Taking Stock. We're bang in the midst of earnings season. This week has been frenetic in terms of earnings, and next week promises to be a very frenetic one as well. And there is a monetary policy meeting on Tuesday just to make things even a bit more interesting. The first part of the week, very sluggish, very tired markets. A little bit of a lift up from global markets towards the end of the week, and earnings mixed. There are hits and misses from the large cap universe for this week, and in the midst of that, the market or the Nifty is just hovering around that 5,000 mark. Opinion now increasingly divided on whether the markets have run ahead of themselves or there is a last bit of a melt up before the year is out as money chases performance. To talk about that, we have with us Pankaj Vaish of Nomura India and KR Bharat of Advent Advisors. Gentlemen, thanks for joining in. Pankaj, let me start with you. Are you bullish or bearish from here on?
From here on, I think we still go a little bit higher, perhaps 5,300, something like that. I think the sentiment is still overall pretty positive. Over Diwali, everybody was in a great mood. Inflows are still pretty decent. So, and I think the Chinese market actually looks, after a pretty severe correction, looks like it's well supported here. So, I think a little bit higher. My one concern has been, and I think that's coming a little more to the fore, I hear more people talking about is interest rates. So if bond yields within sort of shouting distance of 7.5, and if those break, then I would be concerned. And that's the one worry I have even about sort of sector-wise in terms of financials and all that. But I think a little bit higher still first.
Bharat, you've been a bit circumspect. Do you continue to hold that view, or has anything changed since we last spoke?
No, I don't think anything has changed. Then, in fact, if you recollect the last time we spoke over the channel, I said, the party you should be scared, but the party will continue for some more time before the correction happens, and I stick with that view. I think, you've got another 2 to 2.5 months left for this party to continue. I certainly don't see any great danger to this rally until the end of the year for a variety of reasons, which I'll get to. But next year, 2010, I'd be very, very circumspect. I'd probably be tempted to pull some money out of the market. I'd be bearish. And then long term, of course, I'm very, very bullish Indian equities, global equities, but certainly Indian equities. So I would say immediate term bullish, and then medium term, if one can call next year that, I think will be a time of correction and consolidation, and then thereafter, I think you'll see a resumption of the bull market.
If your view is, Pankaj, that there's a last 5-6% left to this rally, what could prick the bubble? Do you think it's going to be interest rates, or it could be something which turns globally?
I don't know, honestly. I actually was expecting RBI to be even more hawkish in their statement, but I think the political pressure is very strong on them to take it easy and sort of, if anything, err on the side of being too late rather than too early. So in my mind, for the last month or so, the thought was we will get towards 5,300, bond yields will break 7.5, and then action. Maybe it starts with CRR, I don't know, something like that. But that would prick it. But it looks like that's receded a little bit, and I think it would be a mistake. But anyway, that's just my opinion. So what else would do it, bring it down? I'm not sure. It's possible that some of the earnings globally, not just in India, actually disappoint. I mean, I know the technology sector globally is doing extremely well. Financials are a mixed bag, and frankly, that's the epicenter of this whole thing. So if for every Goldman Sachs and JP Morgan, you get the Citigroup that's not done so well, and if that sort of becomes a bigger proportion of the overall pie, maybe that's the one that pulls us back. I'm not sure.
What do you think, Bharat? Your call too is that we've got a couple of months left in this party and then things start souring. What do you think will lead to things souring? Or is that just a gut feeling, you can't put a finger on it, but you believe that there's not much juice left in this rally?
No, in terms of timing, I'm not able to put a finger on it. I've said 2.5 months. I mean, there's nothing sacrosanct about that. But in terms of what could trigger it, I mean, if you look at the genesis of this whole rally, I think everybody will agree with you that it's been led purely by liquidity. I think any talk of fundamentals at this stage is ludicrous because, people are not buying equities today because of valuations. People are buying because of momentum. People are buying because they think that more money will come into the equity market. And just as as something for you to chew on, I'm told that in the last 3 3 months, the total redemptions in the US in money market mutual funds were at the order of $320 billion. Obviously, because, money market mutual funds are earning pretty close to zero. Where do you think this money has gone? I mean, I don't need to be a genius to say that it's gone into equities and commodities. So, the liquidity story continues unabated. There's huge amounts of money being thrown at financial assets, which is why this market has gone up. So any correction, therefore, the trigger will have to be a reversal of this liquidity. So what could lead to a reversal of liquidity? I mean, the most logical answer that comes to mind, and let me preface that by saying that logic hasn't really worked for a long time in these markets, but the logical thing that comes to mind is to do with global interest rates and the US dollar. I mean, the rate at which the US dollar is depreciating, 2 or 3 things are happening. One is you're having inflation, imported inflation, supply side inflation across the globe. The average American is getting poorer, which is not, politically, the most savvy thing that an American politician can do. At some point in time, either to shore up the falling dollar or, to prevent the specter of inflation from getting out of hand, you're going to see some kind of interest rates hike in the developed world. Now, the reason I said 2.5 months is one, I don't think anyone wants the party to end, and December is when I would say most people would like markets to be high because of NAV and other things. But on a more serious note, I would not assume any major changes to interest rates happening in this calendar year. I would see it happening more likely in the first quarter of next year. Therefore, I think that is probably more likely to be a trigger of the reversal of liquidity from equity markets into other asset classes, whether they be money market or whether they be an overall reversal of liquidity. Because remember, you had the worst tsunami that, financial markets have ever seen, and, the crisis is over because, governments have printed money. I mean, logically, that doesn't make sense to me. So the liquidity reversal is what is going to create a correction, in my opinion. And I would say the first trigger will come due to inflation concerns, due to concerns of the falling dollar, because of which, interest rates may go up in the US.
Pankaj, what do you think about the dollar? Because that's also been a key reason why commodities and equities have seen such a big rush of money. Do you think the dollar is pretty much done with its decline and can snap back, which might snap the equity party?
No, I think the dollar will stay weak. I think it is, in fact, part of the overall package of things the U.S. needs to be able to sort of pull out. So you've already seen, in fact, the current account deficit in U.S. go from about 6% of GDP to about 3%. So I think they would want it to, I think the forces, still cyclical ones, are that they stay that way. The one thing about the dollar, though, is it has broken down a little bit in terms of its correlation across various crosses. So you have the euro and the Australian dollar doing extremely well against the US dollar. Sterling, for example, is still lagging a little bit. And I think, frankly, the Asian currencies have lagged. I think that is the one big thing that still will continue. I'm very bullish on the Indian rupee. I think Asian currencies overall will strengthen quite a bit more against the US dollar.
You think the rupee could go to 43, 44?
Yeah, I think so.
Soon?
I think so, yes. I think before the end of this fiscal year.
Let's take a break. Lots to talk about, lots of sectors, stocks, etc. Do that in a minute when we come back.